Hey everyone, and welcome back to the Deep Dive. Today we are diving into some seriously clever tax deductions specifically for businesses. You know, the ones that help you keep more of your hard-earned cash? We've got a whole bunch of sources here, and some of them are pretty counterintuitive. Like, get this, you might actually want to wait on sending out those December invoices.
I know, right?
Oh.
Wild. So get ready, because we're going to unpack some game-changing tips that could save you big time by year's end.
Yeah, it's amazing. The IRS actually has some rules that can really work in our favor. It's almost like they're saying, hey, we know running a business is tough, so here are a few ways to be strategic with your taxes.
Okay, so let's start with this IRS safe harbor thing. Kind of sounds intimidating at first, but it's actually designed to benefit us taxpayers. So what is it exactly?
Well, this safe harbor rule lets you prepay certain expenses, things like rent or insurance. You can prepay up to 12 months in advance and deduct those expenses on your current year's taxes, even though you won't actually use the service until the next year. So let me see if I get this. Say I write a rent check for the whole next year on December 31st. I can deduct that whole amount on this year's taxes, even though my landlord won't cash it until January.
Exactly. You got it. Think of it as shifting your tax burden to a year that might be better for you. Say your rent is like $3,000 a month. You mail that check for $36,000 on December 31st. You get to claim the full deduction on this year's taxes. Your landlord reports it as income next year when they get the check, so it works out for everyone.
Okay, now that's what I call a win-win. But hold on, this doesn't work for like every expense, right? What are the catches?
You're right. It's not a free pass for everything. It mainly works for things like rent or lease payments on business vehicles and insurance premiums. You can't just prepay your entire supply budget and call it a day.
Good to know. So we've got one strategy down, but this next one is a bit of a mind bender. We're actually going to talk about delaying invoices on purpose. Sounds crazy, right?
I know it seems counterintuitive, but this can really be a game changer, especially for businesses that use cash-basis accounting. That means you only pay taxes on the income when you actually get the cash.
So if I'm a cash basis business owner, like let's say a dentist, and I wait to send out patient bills until after December 31st, what happens then?
You just shifted that income
Yeah.
and the taxes you owe on it to next year. It's a really smart way to manage how much you owe in taxes. Like, let's say this dentist usually bills patients at the end of each week. But this year, he waits and sends out those December invoices in the first week of January. Boom. That income is now part of next year's taxes.
Wow. So it's all about timing those invoices just right. We're prepaying some things and delaying others. But I got to ask, are there any limits to this? Where does the IRS draw the line?
That's a great question. These strategies are totally legal and they work. But it's always important to remember that the IRS is making sure everyone is paying their fair share.
So no burying treasure chests in the backyard to dodge taxes, I guess. All right, moving on. Let's talk about how investing in your business can actually get you some nice write-offs. I'm talking about Section 179 expensing and bonus depreciation. Those sound like some scary accounting terms.
They might sound intimidating, but they're actually pretty simple. Section 179 lets you deduct the full purchase price of qualifying equipment, stuff like machinery, computers, furniture for your office, as long as it's purchased and put into use during the year. There's a limit, of course. And bonus depreciation lets you write off a big chunk of the cost right away, instead of spreading it out over a bunch of years.
Okay, so we're talking immediate tax benefits. I think every business owner loves to hear that. But how much of a difference can these deductions actually make?
The savings can be huge. It really depends on what you're buying and your overall tax situation, of course. But we could be talking thousands of dollars in savings, especially if you've been thinking about upgrading your equipment anyway.
All right, listeners, take notes. This is gold. And that's not all. Next, we're going to dive into something that's often overlooked: timing those credit card deductions.
Credit card deductions can be a little tricky. The rules actually change depending on how your business is set up.
Okay, so break it down for us. What's the catch with credit cards?
For sole proprietors or those single-member LLCs, the deduction happens when you charge the purchase to your card. But for corporations, it can get a bit more complicated. If the corporation has its own credit card, it's the same rule. But if you're using a personal card for business and getting reimbursed by your corporation, the deduction happens when you get that reimbursement. So make sure you get those reimbursements processed before the year ends.
That's a really good point. It's so easy to forget about those reimbursement timelines, but they can make a big difference when it's time to file taxes.
Absolutely. And speaking of tax time, let's talk about something that might be on your mind. What if you're worried about claiming too many deductions?
Yeah, I've heard that from other business owners. They're afraid it'll raise red flags or get them audited. What's the truth about that?
It's a common worry. But listen, claiming legitimate deductions is not only your right, it's super important for keeping your finances accurate. The tax code is actually designed to help businesses. And there's this thing called net operating losses, or NOLs. That can actually work in your favor, even if your business ends up with a loss for the year.
NOLs. Tell me more about that.
If your deductions end up being more than your income for the year you got an NOL, nobody likes operating at a loss, but the good news is you can actually carry these NOLs forward to future years. That way you can offset profits and lower your taxes in those years.
So even a loss can have a bright side. But there's got to be a catch, right?
The key here is documentation. You absolutely have to keep detailed records of every single deduction. Keep those receipts, track those expenses, and make sure everything is organized and easy to find.
So basically, we have to be able to back up every deduction with solid proof. Got it. Now let's talk about qualified improvement property, or QIP. What is that all about?
QIP can be a really great deduction if you've made certain improvements to your property.
Okay, walk me through this. What exactly counts as QIP?
Think about interior improvements to buildings that aren't residential, like office spaces or retail stores. And here's the best part. Instead of depreciating those improvements over a long period, like 39 years for real property, QIP is considered 15-year property.
So that means we can depreciate it faster, which means...
You got it. Bigger deductions in the short term. And get this, QIP also qualifies for both Section 179 expensing A&E bonus depreciation. It's a tax-saving triple threat.
Wow, this is getting good. But there's always a catch, right? What do we need to know?
The key with QIP is timing. If you want to claim the deduction this year, the improvement needs to be placed in service by December 31st. That means the work has to be finished and the property ready to be used.
Okay, so no last-minute renovations if you want to claim that deduction this year. Got it.
We've covered a lot of ground here. Our listeners' brains must be buzzing with all these strategies.
We have covered a lot. But it's important to remember that these are just a few of the many tax deduction strategies for businesses. The key is to stay informed, plan strategically, and don't be afraid to ask for expert advice. So before the break, we were looking at some great tax deduction strategies that can really help businesses out. Now let's look at a few more specialized areas. These can have a big impact on your bottom line.
Okay, I'm ready to learn even more ways to save on my taxes. What other hidden gems are out there?
Let's talk about the home office deduction. A lot of business owners think they don't qualify, but the rules are actually more flexible than you might think.
I've heard some kind of scary stories about the home office deduction, like it makes you more likely to get audited. Is there any truth to that? Yeah, there's definitely some misinformation out there. The main thing is making sure you meet the IRS requirements. Your home office space needs to be used regularly and only for business. It can be a separate room, or even just a specific part of a room, as long as it's clearly your workspace.
So I can't just say the couch is my home office because I answer emails there sometimes.
Right. It really needs to be a dedicated workspace. But the cool thing is you can actually deduct a portion of your home expenses, like your rent or mortgage interest, utilities, even homeowners insurance.
Wow. So I can deduct some of my housing costs just because I work from home? That sounds pretty great. Is there a specific formula for figuring out how much I can deduct?
There are a couple different ways to calculate it, but one of the easiest is the simplified method. You basically deduct a set amount for each square foot of your home office, up to 300 square feet.
That seems pretty simple. So keep it simple, follow the rules, and document everything. What else should we keep in mind?
Another area where you might find some extra deductions is travel expenses.
Now we're talking. Travel and tax deductions, two of my favorite things. But seriously, what kind of travel are we talking about here?
Of course it has to be business-related travel, like going to conferences or client meetings, maybe even research trips for your business. You can deduct things like transportation, hotels, meals, and even those annoying baggage fees.
Okay, so maybe that business trip I've been putting off isn't such a bad idea after all. But are there any limits on what we can deduct?
Like with most things taxes, there are definitely rules to follow. The most important one is that the trip needs to be mainly for business. If you add a few personal days onto your trip, you'll need to keep track of your spending really carefully, so you know what's business-related and what's personal.
That makes sense. Speaking of keeping expenses separate, what about taking clients out to dinner? Can we still deduct those?
That's a really good question. The rules for meal deductions have actually changed recently. The good news is you can still deduct 50% of the cost of meals if you're traveling for business. And if you're hosting a business meeting or event, you might be able to deduct the whole cost of the meal. There are certain requirements you have to meet, though.
So taking clients out is still a good business strategy, even when it comes to taxes.
Exactly. Just make sure you keep good records. Things like why you had the meal and who was there.
Documentation. Okay, we've covered a lot today, but I feel like there's still more to learn. What other tax-saving strategies should we know about?
All right, let's switch gears and talk about retirement contributions. This is something a lot of business owners don't really think about when it comes to saving on taxes.
Retirement planning A&D tax deductions sounds like a win-win to me.
Exactly. Contributing to a retirement plan not only sets you up for a better financial future, it can also give you some great tax breaks right now.
Okay, tell me more. What kind of things are we talking about here?
There are a bunch of different retirement plans out there for business owners. They all have their own rules and benefits. But with a traditional IRA or 401k, your contributions are usually tax deductible, which means you can lower your taxable income this year.
So the money we contribute grows tax-deferred A&D. We get a tax break now. That's amazing. But how do I know which retirement plan is the best one for me?
That's an important question. The best plan really depends on your situation. Things like your income level, how your business is structured, and your long-term financial goals. It's always a good idea to talk to a financial advisor. They can help you find the plan that fits your specific needs.
That's great advice. We've talked about so many amazing strategies today, from prepaying expenses to those retirement contributions. I'm starting to feel like a tax expert myself.
That's what we like to hear. Remember, being smart about taxes is all about using every legitimate deduction and credit that's available to you. It's about keeping more of your money where it belongs in your pocket.
Well said. All right, we're going to switch gears again. We'll be tackling some of those common questions and misconceptions that come up around business tax deductions, so stick around.
All right, welcome back to the deep dive. We've been covering some really smart tax deduction strategies for businesses. Now let's tackle some of those common questions and myths that pop up around business taxes.
There are definitely a lot of misconceptions out there, so let's try to debunk some myths and clear things up.
Okay, I'm ready to separate fact from fiction. Where should we start?
Well, one common myth is that if you incorporate your business, your taxes will automatically be lower. Incorporating can definitely have some tax advantages, but it's not a guaranteed solution for everyone.
Yeah, I've heard that one before. So what's the real story with incorporating?
When you incorporate, you're basically creating a separate legal entity for your business. That can give you some liability protection and some potential tax benefits, but it also means more complexity and paperwork.
So incorporating isn't some magic trick for saving on taxes. Not really. It's a big decision, and you shouldn't take it lightly. It's really important to talk to a tax professional and see if incorporating is the right move for your business and your goals.
Sounds like good advice. What other myths should we bust today?
Another big one is that you have to be a huge corporation to get any real benefit from tax deductions. But that's just not true. There are so many great deductions out there for businesses of all sizes, even if you're a sole proprietor or a small partnership.
That's great news for those smaller businesses just starting out. Can you give us some examples of those deductions?
We've already talked about some good ones that apply to businesses of all sizes, things like home office deductions, travel expenses, and retirement contributions. There's a lot out there that you can take advantage of, no matter how big or small your business is.
That's good to know. I think it's also important to remember that claiming these deductions isn't about trying to cheat the system or anything. It's about making sure you're taking advantage of the tax benefits you're entitled to as a business owner.
Exactly. The tax laws can be really complicated, and they're always changing. That's why it's so important to stay informed and get professional advice.
Speaking of professional advice, what role does a tax professional play in all of this?
Honestly, a good tax professional can be a lifesaver for your business. They can help you understand the tax code and find those hidden deductions and credits, and they can make sure you're following all the rules and regulations.
So they're like your tax-saving superhero.
Pretty much. Having a tax pro on your team can save you money and help you avoid making costly mistakes. Plus, it gives you peace of mind knowing that your taxes are being done right.
I think we can all agree that peace of mind is priceless. So as we wrap up our deep dive today, what are some key takeaways our listeners should remember?
The biggest one is don't leave money on the table. Spend some time learning about the deductions and credits that are available to your business. Stay organized, keep good records, and don't be afraid to ask a tax professional for help. If you're proactive about your tax planning, you can keep more of your hard-earned money and put it back into growing your business.
That's a great point. Tax planning shouldn't be something you scramble to do at the last minute. It's an ongoing process. So stay informed, stay organized, and stay ahead of the game.
And remember to have fun with it. Building a successful business is an amazing journey, and being smart about your taxes is part of that success.
Such a great way to end our deep dive. A huge thank you to our expert for all the incredible insights. And to our listeners, we hope this episode has left you feeling empowered and ready to tackle those taxes. Remember, knowledge is power. Now you've got the knowledge to make some smart tax moves. Go out there and make this year your most financially successful year yet. Until next time, happy deducting.